Silver doesn't usually whisper when something important is happening. It moves in ways that look chaotic on the surface, but purposeful underneath. And right now, silver is doing exactly that. Prices are racing higher, headlines are growing louder, and excitement is spreading fast. But excitement is not confidence. And the real story unfolding in the silver market today has very little to do with whether the spot price is $60, $63, or $65 an ounce. The real story is about stress building beneath the surface, about trust quietly eroding, and about a physical market that is starting to behave very differently from the paper market that claims to represent it. Just look at how fast this move has happened. Only a few months ago, in mid-September, silver was trading in the low 40s, around $42 or $43 an ounce. Today, in mid-December, silver is pushing close to $64 an ounce. That is a gain of more than $20 in roughly 3 months. In absolute terms, silver has risen by more in 90 days than its entire price less than a decade ago. That kind of move naturally creates excitement. But it also creates something else. It creates fear. And fear does not show up clearly on price charts. It shows up in behavior. To understand what is really happening, you have to stop watching futures prices alone and start paying attention to how the system itself is responding. Dealer behavior, exchange behavior, inventory behavior. These are the places where pressure shows up first. Let's start with Shanghai, because that is where one of the clearest warning signals emerged. On September 26, 2025, the Shanghai Gold Exchange raised silver margin requirements to 19%. That move barely made headlines, but it should have. And here is why. That was not the first margin hike of the year. It was not the second. It was not the third. It was the sixth. 6 margin increases in a single year. That is not normal market maintenance. That is an exchange repeatedly stepping in to slow something down that it believes could run beyond its control. Margin requirements exist to manage risk. When you trade silver futures, you are not paying for the metal itself. You are posting a fraction of its value as collateral. At 10% margin, $1 controls $10 worth of silver. That leverage works fine when markets are calm and physical supply is abundant. But when volatility rises and physical inventories tighten, leverage becomes dangerous. Under normal conditions, silver margins tend to sit around 10 to 13%. When margins rise to 19%, leverage collapses. Speculation becomes expensive. Holding contracts becomes uncomfortable. And most importantly, taking physical delivery becomes something only the most determined participants will attempt. Exchanges raise margins like this for one primary reason. They are worried about delivery pressure. And Shanghai was not acting alone. In October, the Shanghai Futures Exchange followed with additional measures, raising margins again and expanding daily price limits. When exchanges raise margins and widen price limits at the same time, they are sending a very clear message in technical language. Volatility is increasing. Inventories are tight. And the system is under strain. Now look at inventories themselves. As of December, reported silver stocks in Shanghai warehouses were around 820 metric tons. On its own, that number sounds large. But history tells a very different story. In early 2021, Shanghai held more than 3,000 tons of silver. In just a few years, roughly 75% of that visible inventory has been drained. That is not a comfortable buffer. That is a system operating with very little margin for error. At the same time, inventories have collapsed, trading volume has surged. December trading activity reached the highest levels seen since mid-2024. More paper claims are being created and traded at the exact same time that physical silver is becoming harder to source. That imbalance is not theoretical. It shows up everywhere once you start looking for it. One of the clearest places it appears is in physical premiums. In October, premiums for physical silver across parts of Asia surged to as much as $8 per ounce above Western spot prices. Under normal conditions, premiums might be 50 cents or $1. $8 is not a small distortion. It is a signal of urgency. Buyers were willing to pay 15 to 20% above paper prices just to secure metal. That kind of behavior does not come from hype. It comes from scarcity. When Asian premiums spike like that, metal is supposed to flow in from London and New York. Arbitrage normally keeps the system balanced. But this time, that mechanism began breaking down. Reports from the same period indicated that deliverable silver in London had tightened sharply, with operational availability becoming constrained. At the same time, seasonal demand in India surged, pulling even more metal out of the global pool. Multiple regions were drawing from the same shrinking stockpile all at once. This is what a real shortage looks like. Not a single dramatic announcement, but pressure everywhere, simultaneously. Now contrast that with what is happening at the retail level. Over the past few months, calls to coin shops across the United States have revealed something unexpected. Despite silver prices surging more than $20 in 3 months, many dealers are not paying anywhere near spot for physical silver. For 1-ounce silver rounds, the best offers are often $4 below spot, sometimes $5 or $6. Even for American Silver Eagles, which historically command strong buy prices, many offers remain below spot. That disconnect matters. Dealers live in the physical world. They buy metal, sell metal, and move it through the supply chain every day. When prices rise this quickly and dealers hesitate to bid aggressively, it tells you something about confidence. And what it suggests is caution, not euphoria. Part of that caution is understandable. Silver has risen more than $20 in just 3 months. Dealers remember 2011. They remember how fast prices ran up and how violently they fell. From a business perspective, paying too much for inventory that might lose value in a sharp pullback can be fatal. So dealers protect themselves by widening spreads and lowering bids. But there is more going on than fear of a pullback. Many dealers are reporting a surge in selling. Silver is coming out of storage. People who bought years ago at much lower prices are taking profits. Coin shops are seeing more metal coming in than going out. When buying outpaces selling, dealers are forced to move inventory quickly to refiners and wholesalers. And right now, refiners and wholesalers are not paying aggressively either. Many are backed up. Some are refusing sterling silver. Some are refusing 90% silver. Many are only buying 0.999 fine silver, and even then, at discounts. That creates a bottleneck. Physical silver piles up at the retail level even as global exchange inventories continue to fall. It looks contradictory until you realize these are two different parts of the same system operating on different timescales. Retail selling reflects short-term profit-taking and caution. Exchange inventories reflect long-term structural shortages. Both can exist at the same time. And those structural shortages are real. Industry projections show the silver market facing a deficit of roughly 187 million ounces in 2025 alone. This marks the 5th consecutive year in which global demand exceeds mine supply. Since 2021, nearly 800 million ounces have been pulled from above-ground stockpiles to fill the gap. That silver is not sitting in vaults waiting to return. It is embedded in solar panels, electronics, medical devices, and infrastructure. Mine supply offers no quick solution. Roughly 70% of silver production comes as a byproduct of mining other metals. You cannot simply turn on more silver production because prices rise. New mines take 10 to 15 years to develop. Supply is rigid. Demand is not. And demand continues to grow. Solar installations are accelerating. Electric vehicle production is expanding. 5G networks are still being built. AI data centers are multiplying. Every one of these trends consumes silver, and there is no viable substitute at scale. This is not speculative demand. It is industrial necessity. This is where the paper market begins to drift away from physical reality. Paper silver trades freely because most participants never ask for delivery. As long as contracts are settled financially, leverage can remain high and inventories can remain thin. But that balance depends entirely on confidence. The moment participants begin to care about physical availability instead of paper exposure, the system strains. Shanghai's repeated margin hikes are a warning that this strain is already visible. Raising margins discourages delivery and buys time. But it does not create metal. If demand continues to exceed supply year after year, time eventually runs out. Here is the geopolitical question at the center of this entire story. What happens when a material essential to modern economies becomes scarce in a fragmented world? The answer is already emerging. Governments classify it as critical. Companies stockpile it. Exchanges attempt to contain volatility. and markets built on leverage begin to crack under physical limits. Silver was designated a critical mineral in the United States in late 2025. Governments do not do that casually. That designation reflects concern about supply security. Once it happens, behavior changes. Strategic buying increases. Export risks rise. Geographic bottlenecks form. And global availability tightens even further. So when you see silver prices rising rapidly, while exchanges raise margins, inventories fall, premiums surge, and dealers hesitate to bid aggressively, you are not watching a simple bull market. You are watching a system being pulled in opposite directions by short-term caution and long-term scarcity. Yes, pullbacks can happen. Markets never move in straight lines. Dealers know that. Investors know that. But pullbacks do not erase structural deficits. They do not refill drained stockpiles. They do not eliminate industrial demand locked in by long-term infrastructure buildouts. This is why the silver story today is fundamentally different from past cycles. It is not driven by a single speculative force. It is driven by overlapping pressures that reinforce each other. Industrial demand, investment demand, strategic stockpiling, rigid supply. And now, visible stress at the exchanges themselves. This is not about hype. It is about recognizing patterns while they are forming, not after they have already played out. History shows that when paper markets collide with physical limits, the outcome is rarely gentle. Repricing happens quickly. Confidence shifts abruptly. And the difference between a contract and a commodity becomes impossible to ignore. If you are watching silver only through the lens of price, you are missing the deeper signal. The real story is written in margins, inventories, premiums, and behavior. And those signals are flashing right now. If you want to stay ahead of these shifts, to understand them before they dominate headlines, stay connected here. This channel exists to break down what markets are signaling beneath the surface, where geopolitics, resources, and finance intersect. Silver is not just moving. It is warning. And in markets, warnings rarely repeat themselves twice.